Before anything else, an important clarification, because the title of this video could easily be misread. No diversified equity ETF is immune to a recession. Every fund discussed in this video has declined during past downturns, and every one of them will decline again during a future one. Survive a recession in this video means something specific and honest. Falling meaningfully less than the broad market during historical downturns, and recovering reliably afterward, not avoiding declines altogether. With that said, here is what actually happened to different types of diversified portfolios during two of the most significant recent downturns. During the 2008 financial crisis, the broad U.S. stock market, and, by extension, a fund like Vanguard's Total Stock Market ETF, fell approximately 37% to 38% from peak to trough. During the 2022 downturn, driven by aggressive interest rate hikes, growth-heavy technology portfolios fell 30% to 35%, while certain other Vanguard equity products fell by single digits, or in one specific case, barely moved at all for portions of the year. That third category, the ETFs, that meaningfully cushioned the fall in both of these historical periods, is what this video covers. Specifically, which Vanguard ETFs have historically demonstrated the strongest defensive characteristics during recessions, what they actually hold that gives them this property, and exactly how a Canadian investor should think about using them. Not as a replacement for growth-oriented investing, but as a deliberate stability layer within a broader portfolio. By the end of this video, you will understand exactly which Vanguard products have earned a legitimate claim to recession resilience, and which claims are overstated. What it is: VYM, the Vanguard High Dividend Yield ETF, tracks the FTSE High Dividend Yield Index, holding approximately 450-plus U.S. companies selected for above-average sustainable dividend yields, with REITs excluded. What it holds: VYM concentrates in sectors known for stable cash flows and consistent profitability through economic cycles: financials, healthcare, consumer staples, energy, and industrials. Top holdings as of early 2026 include Broadcom, J.P. Morgan Chase, ExxonMobil, Walmart, and Johnson & Johnson. Crucially, VYM is deliberately underweight in growth-oriented technology compared to the broad market, because most high-growth tech companies pay minimal or no dividends and therefore do not qualify for inclusion. The 2022 Vault answer. Here is the surprise from the opening. During the first several months of 2022, while growth and technology stocks were falling sharply in response to rising interest rates, VYM actually posted a positive return for stretches of that period, before ending the full calendar year down only approximately 0% to minus 5%, compared to the broad S&P 500's decline of approximately minus 18% and the Nasdaq's decline of approximately minus 33% for the same calendar year. This was not luck. VYM's heavy weighting in energy, which benefited from rising oil prices in 2022, and financials, which benefit from rising interest rates through expanded net interest margins, meant the fund's specific sector composition was directly advantaged by the very macroeconomic forces, rising rates, that were punishing growth stocks during that period. The 2008 record. During the 2008 financial crisis, VYM, which existed at the time, launched in 2006, fell approximately 32%, meaningfully less than the broad market's 37% to 38% decline, though still a significant drawdown, illustrating the relative, not absolute resilience this video defined upfront. Financials were themselves at the center of the 2008 crisis, which limited how much VYM's typically defensive financial sector weighting could cushion that particular downturn. The lesson from comparing 2008 and 2022: VYM's defensive characteristics are not universal. They depend on the specific cause of the downturn. In a downturn driven by rising rates and inflation, 2022, VYM's energy and financials weighting was a significant advantage. In a downturn caused by a financial sector-specific crisis, 2008, that same sector weighting was less protective, because the crisis originated in the very sector that normally provides VYM's defensive characteristics. The cost: MER, 0.06% per year, among the lowest of any ETF, Vanguard or otherwise. Dividend yield, approximately 2.5% to 2.8%. Your action step: review VYM's sector composition before assuming it will behave identically in every future downturn. Its resilience is genuine but conditional, strongest against interest rate-driven and growth stock-specific corrections, weaker against systemic financial crises. What it is: VIG, the Vanguard Dividend Appreciation ETF, tracks the S&P US Dividend Growers Index, which screens for companies that have increased their dividend payments for at least 10 consecutive years. Notably, VIG does not screen for the highest current yield. Unlike VYM, it screens for consistency and growth of the dividend itself, which selects for a fundamentally different type of company. What it holds: this screening methodology selects for financially disciplined, high-quality businesses with durable competitive advantages, companies stable enough to commit to raising their dividend every single year for a decade or more, through recessions, through interest rate cycles, through every kind of economic environment. Top holdings as of early 2026 include Broadcom, Microsoft, JP Morgan Chase, Apple, and ExxonMobil. Notably, this list includes some growth-oriented technology names, Microsoft, Apple, alongside traditional dividend payers, because VIG's quality screen, rather than excluding growth companies outright, simply requires a long, consistent history of dividend increases. Why dividend growth companies tend to be defensive: the specific discipline required to raise a dividend every year for 10-plus years, through 2008, through 2020, through 2022, selects almost mechanically for companies with strong, stable balance sheets, consistent free cash flow, and conservative capital management. A company facing severe financial distress cuts its dividend. It does not raise it. VIG's entire methodology is therefore a quality filter disguised as a dividend filter. The historical record: during the 2020 pandemic crash, when the broad market fell approximately 34% in a matter of weeks, VIG fell approximately 27% to 28%, a meaningful but not dramatic improvement, reflecting that even high-quality companies were not immune to the broad, indiscriminate selling of that particular crash. During the 2022 downturn, VIG fell approximately -11% to -13% for the full year, a substantial improvement over the S&P 500's approximately -18% decline, though not as dramatically defensive as VYM's near-flat performance that specific year, since VIG's inclusion of quality growth names like Microsoft and Apple meant it still carried some growth stock sensitivity that VYM, with its tech underweight, largely avoided. The trade-off compared to VYM: VIG offers a different balance than VYM, a lower current dividend yield, approximately 1.6% to 1.8%, compared to VYM's 2.5% plus, in exchange for typically stronger long-term capital appreciation, because VIG's quality growth companies have historically grown both their earnings and their dividends faster than VYM's higher current yield, often more mature, slower-growing holdings. The cost: MER, 0.05% per year, even lower than VYM. Who it is for? VIG is for investors who want a defensive tilt that does not fully sacrifice growth potential, a middle ground between a pure growth ETF and a pure high-yield defensive ETF like VYM. It is particularly well-suited as a long-term core holding for investors who want quality and resilience without giving up meaningful upside participation. Your action step? If choosing between VYM and VIG, consider your priority. VYM for maximum downside cushioning and current income. VIG for a more balanced combination of quality, moderate resilience, and continued growth participation. What it is? VDY, the Vanguard FTSE Canadian High Dividend Yield Index ETF, is the Canadian-listed counterpart to VYM, applying a similar high dividend yield methodology to Canadian companies. It trades on the Toronto Stock Exchange in Canadian dollars. What it holds? VDY concentrates heavily in three sectors that define Canadian dividend investing: Canadian banks, Royal Bank, TD, Scotiabank, BMO, CIBC, National Bank, typically 55% to 60% of the fund. Energy, Enbridge, TC Energy, Canadian Natural Resources, Suncor, typically 20% to 25%, and telecoms/utilities, BCE, TELUS, Fortis, typically 10% to 15%. Why this matters specifically for Canadian recession resilience? VDY's heavy concentration in Canadian banks is structurally different from VYM's more diversified U.S. financial exposure. Canadian banks are widely regarded as among the most conservatively regulated and capitalized in the world, having notably avoided the worst of the 2008 crisis that devastated many U.S. and European banks. This gives VDY a somewhat different risk profile than a comparable U.S. fund during a financial sector-driven downturn. The 2008 record, VDY, launched in 2012, so this is calculated using its underlying index's historical performance prior to the fund's actual launch, would have fallen approximately 30% to 33% during the 2008 crisis based on the historical performance of its current holdings, somewhat better than the TSX broad market's decline of approximately 33% to 35%, reflecting the relative stability of Canadian banks even during a global financial crisis centered largely on U.S. and European institutions. The 2022 record. During 2022, VDY's heavy energy weighting, oil prices rose significantly that year, combined with its bank weighting, which benefited from rising rates similar to VYM's U.S. financials, produced a genuinely strong year. VDY returned approximately plus 4% to plus 6% for the full calendar year 2022, an actual positive return during a year the broader market fell significantly. The Canadian tax advantage on top of the defensive characteristics. As covered in this channel's dedicated video on Canadian dividend taxation, VDY's dividends are eligible Canadian dividends, qualifying for the federal and provincial dividend tax credit, and the entire fund can be held inside a TFSA with zero withholding tax complications, unlike VYM or VIG, which face the U.S. dividend withholding tax nuance when held outside an RRSP. For a Canadian investor specifically prioritizing both defensive characteristics and tax efficiency, VDY offers an advantage that no U.S.-listed ETF can fully replicate. The cost? MER 0.22% per year, higher than VYM or VIG, but still low by mutual fund standards, and the only ETF of the three covered so far with no U.S. withholding tax considerations. Your action step: For Canadian investors specifically prioritizing a tax-efficient TFSA-friendly defensive holding, compare VDY's after-tax expected outcome, accounting for the dividend tax credit and the absence of any withholding tax issue, directly against VYM held in an RRSP to determine which fits better given your specific account room and tax situation. What it is: VBAL, the Vanguard Balanced ETF portfolio, holds approximately 60% global equities and 40% global and Canadian bonds in a single ticker, trading on the Toronto Stock Exchange in Canadian dollars. It is a fund of funds, automatically rebalancing back to its 60-40 target whenever market movements cause drift. Why bonds specifically help during recessions? Bonds, particularly high-quality government and investment-grade corporate bonds, have historically moved inversely to equities during many, though not all, recessions, because falling equity markets typically coincide with falling interest rates, as central banks cut rates to stimulate a weakening economy, and falling interest rates increase the value of existing bonds. This inverse relationship is the core mechanism behind VBAL's defensive characteristic. The 2008 record. During the 2008 financial crisis, a portfolio holding 60% equities and 40% bonds, the VBAL allocation, even though VBAL itself launched in 2018, would have fallen approximately 22% to 25%, compared to the broad equity market's 37% to 38% decline. A substantial cushioning effect, because the 40% bond allocation held its value or even appreciated slightly as interest rates fell sharply in response to the crisis. The 2020 record. During the 2020 pandemic crash, a 60-40 portfolio fell approximately 20% to 22% at the lowest point, compared to the broad market's approximately 34% decline, again demonstrating the bond allocation's cushioning effect, as the Bank of Canada and Federal Reserve cut rates to near zero in response. The 2022 exception, and an important honest caveat. 2022 is the critical exception that every investor considering VBAL specifically for recession protection needs to understand. Because the 2022 downturn was caused by rising interest rates, the opposite of 2008 and 2020, bonds did not provide their usual cushioning effect. Rising rates decreased the value of existing bonds. As a result, VBAL fell approximately -11% to -13% in 2022. Better than the pure equity market's decline, but considerably less protective than the bond allocation provided in 2008 or 2020, because both the equity and bond components of VBAL were under pressure simultaneously from the same cause: rising rates. The critical lesson: VBAL's defensive characteristic depends specifically on interest rates falling during the recession, which has been the historical norm but is not guaranteed in every future downturn, particularly one driven by inflation requiring continued rate hikes even during economic weakness, a stagflation scenario. This is the single most important nuance for any investor relying on a 60-40 portfolio for recession protection. The cost, MER, 0.24% per year. Who it is for. VBAL is for investors who want a complete, single-ticket, hands-off portfolio with meaningfully reduced volatility compared to an all-equity holding, who understand that its defensive characteristics are strongest during traditional recessions, falling rates, and weaker during inflation-driven downturns. Rising rates. Your action step. If holding or considering VBAL specifically for recession protection, understand the interest rate mechanism behind its defensiveness and recognize that a future downturn accompanied by persistent inflation could produce a less protective outcome than the 2008 or 2020 historical record might suggest. Let's come back to where we started. The broad market fell 37% to 38% in 2008. Growth and technology stocks fell 30% to 35% in 2022. And a specific category of Vanguard products, the ones covered in this video, demonstrated meaningfully better outcomes in at least one, and often both, of those periods. VYM fell only 0% to 5% in 2022, thanks to its energy and financials weighting, though it still fell a substantial 32% in 2008, when those same sectors were at the center of the crisis. VIG fell a more moderate 11% to 13% in 2022 and 27% to 28% in 2020, offering a balance between quality-driven resilience and continued growth participation. VDY, the Canadian-listed equivalent, actually posted a positive return in 2022 and offers the added benefit of Canadian dividend tax efficiency inside a TFSA. VBAL cushioned both 2008 and 2020 substantially through its bond allocation. But the critical, honest caveat is that this protection depends specifically on interest rates falling during the recession, which did not happen in 2022 and may not happen in every future downturn. None of these ETFs is immune to a recession. Every one of them has declined, sometimes substantially, during real historical downturns. What they have demonstrated, with real historical data rather than marketing claims, is a meaningful, though conditional and never guaranteed, tendency to fall less than the broad market and recover reliably. The most honest, well-constructed approach for a Canadian investor is not choosing one of these as a complete replacement for growth-oriented investing. It is understanding each one's specific mechanism, recognizing which type of downturn each is best suited to cushion, and sizing a deliberate allocation to one or more of them, alongside, not instead of, a core holding like XEQT or VFV, based on your own risk tolerance, time horizon, and how much volatility you can genuinely tolerate without making a costly emotional decision during the next downturn.